Hello, once again, we are welcome to this beautiful session. So we have looked at budgeting, functional budget, and how it runs from the sales, the revenue, through to the production, and then a breakdown of the production, and then afterwards to the overheads, and then the service overheads, of course. So let's now drill down and look at what we term the flexible budgets. Okay, so budgeting, ideally, we call for it to allow some room for flexibility, okay? So that we can always try to work out some variances and see where we can improve as an organization, okay? So let's take a deep dive into the flexible budget. So like the name sounds. So we'll be looking at approaches to budgeting, the standard cost card, flexible budgets, and then some basic variance analysis, nothing too complicated or technical. And then we also look at the responsibility centers, the cost centers, revenue centers, investment centers. Now, in terms of budgeting, budgeting deals with something we need. We try to convert these action plans into numerical data so that we can always use it for planning and for decision making. How do we gather data? There are some approaches to budgeting. So we have the incremental budgeting approach, okay, where figures will be based on the same figures from the previous period. So if last year we're dealing for another, we're working on another budget for this year, we just pick last year's and just adjust it with some incremental factor, maybe some 5% inflation rates. So we just change the variables. Quite basic, okay, easy. It is usually low cost, simple approach because we use last year's figures. But of course, errors from last year could be carried forward into this year. So one period's errors could be carried forward into the next period's errors. We also have the zero-based budgeting where we start from scratch. So we don't use last year's figures. We start from scratch. It is quite time consuming and it could be very expensive. But of course, this helps us to reduce errors, any risk of errors. So the budget starts off with no preconceived notion of demand or revenue because we start from scratch and brainstorm. So it is more open to new opportunities. We can fix in new opportunities and try to build the organization from scratch. It allows for creativity. It allows for innovation. Okay, so that's one other thing. Again, we can update this budget data, okay, based on those two main approaches we've chosen. Of course, there can be other approaches, but based on this, we can also update our budget data using some approaches. So we have the fixed budget. That one, nothing changes. You cannot alter it. So it remains unchanged, irrespective of changing levels and activities. Therefore, the budget more or less becomes irrelevant if we see that activities are changing. So it doesn't compare to realism, okay? We also have the flexible budget where we update the budget to reflect new budget sales or activity. That's the focus of our work today. So where we update the budget to reflect changing trends in the organization. So it helps us to make comparison and to perform some variance analysis where we compare the actual performance to the realistic figure, okay? So you can see the original budget, but then the actual comes in. So let us update it to the actual. Let's flex it. Okay, we flex the budget, so more or less. We also have the rolling budget. It is more useful for companies that operate in highly volatile, fragile products. Okay, so volatile products, raw materials, or even countries. Okay, so future costs and revenues cannot be predicted. It is usually updated by adding on or building on from the previous year. So we have the previous period, and then we add on, we roll over. So we delete the old data, we roll over with the new data sets, okay? So that's the key thing we should look out for. There are some key items we need to understand, what we call the standard cost card, okay? So the standard cost card helps us to identify the standard cost, the standard quantity, standard revenue, okay? So a standard basically is a budgeted unit cost, budgeted unit quantity, or a revenue. So kilograms per unit in terms of material measurement, labor hours per unit, rate per hour, okay? And then selling price per unit. So these are the standard things we've looked at in the past, okay? Standards are basic elements. We need them to prepare our budgets, and they have various functions, okay? They help us to predict the future. They help us to set targets. Standards are the building blocks for the budgets, okay? And then standards also helps us to undertake variance analysis. And so we need these standard costs in our budget at all costs to be able to run the budgeting product or budgeting process. Okay, so we need a budget standard cost card, which will give us the budgeted cost, the revenue, the profit per unit, and then we can easily compare it with our previous approaches and our absorption or marginal costing. All right, so they fit into each other. There's nothing so complicated about it. There's nothing, so like I said, it's practically basic. There's nothing so complicated. Let's take an example of a standard cost card. Okay, so we have the standard cost card where we have the material. Okay, so these are all per unit items that we can find over there per unit. So we're looking at a typical one. This is a selling price per unit. So our material, we need 4 kilograms. The rate per kilogram is 5. So we get 20, okay, for the product. Let's say if it is Flying Z or Bellicaster, we need 3 hours of manpower, okay, to invest or to work to be able to produce that product. And each hour we pay £8. So at the end of the day, we pay £24 per unit that we produce. So assuming we have a variable production overhead of 5, that'll be it, okay? Fixed production overhead we've absorbed, let's say per hour is £3. So for each hour, we use 3 hours, let's say fixed overhead, it gives us 9. So at the end of the day, the standard cost card, our standard production cost is 58, and we try to say, let's say, make a profit, okay, of 42, because if we compare the selling price, okay, to the cost, we realize that we're making a profit of 42. So this is our selling price less our production cost, okay, our production cost. So gives us 42. Okay, so this is a simple standard cost card per unit of a product that we could use. Okay. Sorry, let's kick on. So the activity cost card, we used it in our absorption costing approach. You remember? You also remember the marginal costing approach. Okay, so we can use the same data. We can prepare the same standard cost per unit. Okay, so at the end of the day, overall profit should be the same. At the end of the day, overall profit should be the same. So let's kick in again and see. So from the same old story, from the data that we have, nothing changes. Okay, so we have our selling price. Let's split them into variable. Let's split all of them into variable. So these are all variable costs. Okay, so our total variable costs, if you sum them up per unit of a product, okay, gives us 49. Okay, so 49. So our contribution gives us our selling price, okay, less our variable cost, which gives us our contribution of 51. Now we take out our fixed overhead absorption, okay, and then we get our profit of 42. So it comes back to the same thing. So we have our contribution minus our fixed cost gives us a profit of, again, 42 under marginal costing, okay. So nothing changes much. Now let's go into our flexible budget. So flexible budget will have our original data and then our updated flexed budget. That's what we need. So original data and then the updated flexed budget. Then it will give us our actual results. Then we work out our variances. So for the flex budget, we are looking at comparing the flexed, be careful, to the actual, not the original, the flexed against the actual, okay? So simply that's it. If our actual outperform the budget, it's favorable, depending, okay? So, but if actual cost is more than the budgeted cost, the flexed, it's not a good thing, right? It's not a good thing. If our actual is exceeding what we budgeted, that's unfavorable, that's adverse, okay? But if our actual revenues goes far beyond our flexed budget than our plans, that's favorable, okay? Take a good look at that, all right? So the same applies. So when our actual results underperform the budget, it could be adverse, depending on whether you're analyzing from a cost perspective or a revenue perspective, all right? Excellent, let's proceed and see. So let's take an example, okay? Let's say we have the unit costs are here, okay? So let's say we had an original unit we budgeted we could sell 2,000 units, but we ended up flexing, realized that demand will not be as planned. Demand would have dropped by 200 units. So we're actually going to be selling 1,800. Now, based on the original budget that we had projected for the units that we will sell. We made this analysis. That's the analysis we made, that if we sell 2,000 units, then we make a revenue of 2 million, multiply it just by the unit cost, okay? Variable cost will be multiplied by the 2,000, 24 by 2,000, 5 by 2,000, 9 by 2,000, okay? So this is what we got. And then we subtracted our fixed overhead, which is independent of the units, okay? So at the end of the day, we were anticipating we'll make 54,000. But what happened? We realized that customers will not be demanding as we required, as we thought. There was a shortfall of 200. So what do? We flex the budget and then re-project. Okay, so we flex and re-project. So if we should flex it, we are getting 1,800, no longer 2,000. All right, so our revenues then change. It drops. It drops, okay? So still we are budgeting. This is not actual. We are still budgeting. Take note of that. So we then budget everything and realize that now our original would have changed to 45,600. We are still budgeting. Take note of that. We are still budgeting. Now, when we get the actual, we then compare. Okay, so remember our budgeted profit had now changed to the actual flexed, what we now realize, to 45,600. Now, in reality, when we did the sales, we realized that instead of 180,000, we got a sale of 162. Maybe there was some discounts we gave, okay? Maybe selling prices dropped in some areas, okay? But still with the same 1,800 actual units. So our sales would have dropped, has changed, okay? The same applies. Material cost, which we thought was 36, is now 32. Perhaps prices changed, okay? Anything could have happened. We got some discount from suppliers. Same applies to labor, same applies to variable overhead. Fixed overhead, which we thought should have been 16,200, now became 13,600. Okay, that's interesting. There's a drop, and then our fixed non-production, which we thought could have been 30, became actually 26. So at the end of the day, our profit has also changed. So what do? We compare our flexed to the actual. This is where we do variance analysis. So in plugging in our variance analysis, realize that our sales dropped adverse, unfavorable. From 180,000 to 162, it dropped. That's unfavorable, okay? That's adverse from the revenue perspective. But what about the cost perspective? Our flexed was lower. Remember what happened to the revenue, okay? Revenue here, flexed was higher, but actual was lower. It is adverse. Don't use the same analysis here that this was also lower, so it should also be adverse. No, we are dealing with revenue, different angle. We are now dealing with cost. Okay, here you can realize that actual cost dropped as compared. Actual cost here dropped as compared to what we flexed. So we saved something. We saved something. The same applies here. Actual was higher than the flexed. So we lost. We lost something here. Again, we lost something here in terms of the variable production overhead. But when we come to the fixed overhead, realize that when we thought we would have incurred 16,200, we actually spent 13,600. We saved. We thought we would be spending 30,000 for fixed non-production overhead. We actually got 26. We saved. At the end of the day, do some knockoff and realize that it's not too good at the end of the day, the picture, okay? Total cost, we saved a total cost of 5,600. But if we compare it, knocking it off against the revenue we lost, we realize that we actually lost so much. Okay, so it was adverse, unfavorable to the organization. Okay, so this is what we mean when we talk of flexed and then actual and then finding the variances. Okay, so the variances will tell us areas we need to work on, and so management by exception, find out why that word, you find it, MBE is a key term in our business language, okay? Again, managers should concentrate on variances they can control. Some fixed overheads, we cannot control them, we leave them. But for the ones we can, especially the variable ones, less variable cost elements, let's fix them. Okay, so they are of great concern. They are of great concern, and there could be various explanations for a variance. It's easy to calculate the variances but the explanation should always be provided. So there are various explanations you can give. Why has sales dropped? Maybe selling prices dropped. Okay, selling price per unit dropped. Maybe there were some returns. We sold, but some were damaged. We had to return. The customers had to return them, or we give discounts. So those examples, those explanations are the main important things we need to find. So remember, we are comparing the flexed to the actual, not the original to the actual, the flexed to the actual, okay? No need for formula in these areas, okay? So like I said, what are the examples? What could account for the changes in the sales, the materials, the labor, the overheads, okay? So like I said, there could be market price, there could be competition, supply dropped, demand increased, demand dropped, okay? New markets popped up, okay? What about material? Could be prices, there could be issues with labor efficiency or machine efficiency, there could be discounts from suppliers, and also maybe quality of the materials we purchased. Labor, same scenario, we could have a number of reasons why labor cost or has risen or has decreased, and a number of them have been cited here for reference, okay? So efficiency of labor, balance of skilled to unskilled labor, minimum wage requirement, let us pay them living wages, so it could also impact. And then quality of machines and machinery and materials that we use could also impact the efficiency of labor. Same applies to overheads. It could be market prices for utilities could have changed. We could have changed suppliers from Scottish Gas to maybe some other supplier, okay? Increased capacity costs, unexpected costs with least expected just popping in depending on variety of overheads, okay, so on and so forth. So these, think aloud, could always give you examples. Okay, let's take a typical example here, and you can easily calculate. Remember, we are comparing the flexed, okay, flexed versus the actual, okay, not the original. So you can easily work it. So what is the material cost variance for the following data? Original budgeted unit is this. Original budget cost is this per unit, but the actual unit was this. So you don't need the original units again. You don't need it again. So we compare our actual. Now the actual material cost became 46,000. So the actual cost was 46. What about the flexed? So the flex then becomes the 4,000 times 12, right? What answer do you get? Compare this answer to your actual. So remember, this is still budget, okay? This is still budgeted. Compare this, your budgeted answer you get, okay, against the 46 actual. And we are dealing with cost, okay? We are dealing with cost. So if you get 48 versus 46, okay, this versus that, okay, 48 versus 46. It is a cost. You thought you will incur 48, you got 46. Is it adverse or favorable? Okay. If you mistakenly use 50 against 12, what do you get? You get 60,000. And if you compare 60 to 46, what do you get? You get 14,000. So it is quite tricky, but not tricky. This is very easy. Okay, we are not dealing with original against the actual. We're dealing with flexed against the actual. So it's the same principle you can use to work for this. So easy to work, okay? Quite easy, quite easy, quite easy. There's nothing difficult in this course, quite easy. So try on your own to work this and see what answer you get. Perfect, let's move on. So there could be non-profit sector examples, okay, where they also run budgets because they get some subventions from the government that they need to run budget analysis to check, okay? So for example, Scottish government will give some good grants, subsidies to health providers in order to promote some diabetes awareness throughout the country. Now, a local health center could have taken up the grants and decided that I'll use some mobile diabetes vehicle or van to offer free advice and blood tests to people around the community. The government and then the local health center would still need a budget to plan for the delivery of the service and also to account for the performance. You get the money, let's account for it, okay? Did you meet the conditions applied, conditions that follow the grants, and were you able to meet your requirements? Were you able to meet whatever you were doing, okay? So we do a simple budgeting analysis. So let's say we budgeted, we would actually do 50 week visits and visit 100 clients per visit. That's what we thought. So originally we planned 50 week, we ended up 49. Now government said, I'm gonna give you 100,000, it's fixed grant. Yes, whether you go 49 or 50, it's fixed grant. But again, you have to explain why you went for 49 and not 50. Okay. Maybe one week your vehicle broke down. You wanted to go for repairs. Okay. Maybe there was some strong weather conditions, you couldn't go. Maybe there was a lockdown, you couldn't go out, so you wouldn't get any good feedback. Now, these are the materials we projected, the material cost together with the fixed cost which we've projected. So per unit, fixed costs have no per unit, okay, remember? So we work them out, and originally we thought we'll make a surplus of 12,000, but since we reduce it by 1 day, we're making an extra surplus of 1336. Now, let's see the actual thing which happened. So we thought we are now going to be making 13,360 after we flexed it and realized the changes. But actually, yes, we ended up 49 visits as we flexed, as we thought. Fixed grant, this doesn't change regardless of what you get because they said the grant is fixed. It's a fixed grant. Now, at the end of the day, when we went on to do our testing and free advice, this is what we realized. So the actual cost against the flexed, we thought we would spend 24,500. What did we spend? 26. Adverse, we lost. We thought we would have 2 nurses, okay, and the cost would have been 39,200, but we ended up paying them extra. Maybe these guys were senior nurses and their hourly rates were high, or we needed to pay them some living wages, not minimum wages. So again, we lost extra to 800. Again, fuel to the various locations, we realized that we saved some fuel costs of 740. Excellent. Then for repairs and maintenance, we budgeted 6,000, not knowing we had to spend extra 2,000. Adverse. And then there was this office administrator's salary. We thought we'd give him 14,000. This guy came with high qualifications. We paid him 15,000 extra. We lost. At the end of the day, when we thought we were going to be making a profit of 13,360, we end up making a surplus of 6,800. So again, there was a shortfall in terms of the actual variance, actual profit that we made. Surplus. Let me not use profit. Profit is more for profit making. We made a surplus of 6,800 from the grant received from the government. So we need to provide explanations why those drops, why those increases. Okay, those are the main things. Okay, so we have an example. Let's say prepared, original, and flexed. This is the original 1,000 units to sell. But when we flex, we realize no. We are getting higher demand, okay? The competitors have left the system, so we can sell more. So realize we can sell 1,200, extra 200. Very easy to plot this, right? Very easy, very easy. So realize that when you do this, plotting, multiplying them by the units, we realize that originally we thought we could make profits of 10,000, but when we flexed, we're getting extra 4,000, extra 4,000, excellent. So that's it. You could do, if there were actuals, you can then budget, check against the budgeted and do your variance analysis. So Drury's book on management accounting and decision making is key. It's a recommended text, please. If you have the time, the money, get it. So responsibility centers, Drury define it as a unit of the firm where an individual manager is held responsible for the performance of that unit. So it could be an investment center, a cost center, or a revenue center. So the way of splitting up the business into various areas, like I said, could be cost, revenue, profits, okay? So that we assign it to a manager who will be held responsible for whatever performance that goes on in that unit. So we have different size, different types, and this is purely because of decentralization. We don't want all the activities to be centered on one place. So you do this, you do that, and then we pull it together to make the company a whole unit, all right? So we have a cost center, okay? Like the name sounds, cost. We have a revenue center, like the name sounds, revenue. what helps us get profits? It's a combination of these two, right? Now feed into this. And what about investment? Okay, so these are the divisions that we can always look out for. Now let's go quickly into what a cost center is. So like I said, managers are held responsible for the costs under their control. There are some costs which are outside, so there could be pardon for that. So okay, managers are held accountable for variances between the budget and actual. So standard cost centers, they will facilitate variance analysis, compare input to output resources, okay, and then try to explain. There could be discretionary cost centers which could exist, okay. In that case, an input and output report, input and output relationship is more important, it's more difficult to ascertain because these are discretionary. We don't normally know when they could come. They come in and we have to allow it to work, okay. So like research and development, advertising. So it's quite difficult to try and control this, especially as they are fixed and we cannot control them, okay. Revenue centers, managers are held responsible for financial output in the form of revenue typically. So a regional sales manager, a divisional sales director, okay. So we're looking for revenue. So of course, they also incur some cost, but that one will be held under the control of the cost manager, okay. So could also be responsible for sales, like I said, related expenses, but not the cost of goods and services. So they are more running item that deals with their department, the marketing, the revenue. So anything about sales expenses, bonuses, some parties to clients, I mean, they could also be held responsible. But in terms of cost of production of the goods and services, that is not theirs. That goes under the cost center. So profit center combines the two, okay? So a cost and revenue centers are limited in their ability. So cost center managers are responsible for costs with no control on discretionary cost, okay? And also with no control over outputs. Revenue centers are responsible for revenues with no control over manufacturing cost, okay? But the profit center manager, they have responsibility for both costs and revenues, okay? So they set the prices, they look at marketing prospects and select the markets, and then look at product mix and supply. So they are more, let me say, supervisory, okay, having oversight responsibilities over the two, okay? That's it. So take a good note. Look at some questions on your own, try and figure it out, okay? In addition to revenues and cost, profit center responsibilities, managers could also have the authority to make investment decisions, okay? So here, these guys will report to the whole company, to the whole units and divisions. So they are more senior guys, so responsible for the whole company, strategically placed at the top, okay? And then they represent the highest level, like I said, at the top of the decision-making ladder. And they are judged based on returns on investment and the use of capital, okay, the loan capital to take decisions. Responsibility centers, let's take a quick one. KFC are fast food chain operating throughout Scotland. Can you identify the responsibility of each manager below? Simply look at it. So this is Kenny, this is Bill, this is Stacy, and this is Arthur. So this is what Kenny says: I'm in contact with Bill and Stacy, discussing ways to increase our bottom line. This guy is in contact with who? Bill and Stacy. Let's look at the roles of Bill. Bill says, I'm in charge of shifts and stock orders. Shifts and stock orders, okay? Production shift, labor shift, and stock orders, okay? I'm using my marketing knowledge to attract more customers. Can you see where this guy is? Marketing, okay? To attract more customers. All right. And this guy, I'm in charge of the stock orders. And this guy controls both. So more or less, they liaise with him. Where would this guy fit? Okay. And then the other guy, Arthur, more or less a standalone guy, he says, I'm evaluating possible purchase of new stores and franchises. This guy is looking at expanding the company, investing. Okay. So this guy is standing alone and trying to expand the operations. So where would you put this guy? Where would you put this guy? Cost? Where would you put this guy? Revenue? And where would you put this guy? Profits? And where would you put this guy? Investments? Where would you put them, right? Okay, very easy to work through. So control, we need to always distinguish between items the manager control and those that they cannot control. So in practice, it's sometimes difficult to apply this controllability principle since some areas could be partially controlled, others we cannot control. So cost and revenue variances, which are caused by uncontrollable external factors, what can we do? What can we do? We can't control it, okay? So we don't hold this guy responsible for something he cannot control. Uncontrollable budget elements should be excluded from budget performance or should not be used to evaluate the performance of the manager. And then our flexible budgets are useful to adjust for activity volume and then levels to help in variance analysis. So they need to have flexible budgets, okay? So take a good look at these charts and see who is responsible for what and who can control what, okay? So just a typical scenario, cost of electricity, which leads into product, the price, the purchasing manager, okay? Electricity usage fits into some areas again, the hours we use, technical efficiency, who is in charge, the engineering manager. Production manager is in charge of the non-production and productive, okay? And I also have another production manager in charge of productive hours, and then hours per unit, so on and so forth. So who is responsible for what, okay? Take a quick look at this and try to understand the chart. Finally, which of the following statements do you think are true in terms of budget responsibility? Cost center managers have overall responsibility for profit. Costs, profit, is it true? Revenue managers have responsibility for revenue-related costs. Revenue-related costs, okay? That's the emphasis, key. Excellent, very easy to identify this. Profit center managers have responsibility for both costs and revenue. Makes sense, right? Investment center managers are less senior. Are they less senior? Are they less senior? No, they are more senior, okay? Which of the following statements are also true? You can easily work this, okay, in terms of budget responsibility. So please don't give room for anything whilst you are capitalizing on the calculations and numbers. Look out for the theoretical understanding as well, because your multiple choice covers both areas, not just numbers, okay? So managers should be held accountable for costs in their department, for all costs. All costs, is it true? What about the ones they cannot control? One person would be responsible for a cost that is adverse or over budget. One person would be responsible for a cost that is adverse or over budget. One person, check it well. Managers cannot control all costs within their department. Managers cannot control. Is it true or false? Okay. Controllable costs are most important in assessing budget performance. Okay, quite easy to identify this. Which of the following statements are false? Which of the following statements are false? Okay, so that's the question. All right, so at the end of the day, we should be able to know how to gather data, how to update data, okay, using the data, the budgeting approach, okay, and then using either the flex, fixed, or rolling, okay. And then we should be able to explain the information in a standard cost card. We can easily apply a flexible budget to identify variances, okay? So we update the original to the new sales level and flex it, okay? And of course, we can easily calculate variances, but must be able to explain why the variances are occurring and the functions of the rest of the centers we found in our organization, the profit center, the cost center, and then the investment center. Again, we give you 10 key concepts which you can run through at your own pace and be able to understand what these key terms mean. All right, excellent, very easy to do. So our next thing is to look at, our cash budgeting, which will be the last piece for the exploring management accounting. So I hope you're enjoying it, and I hope you are doing well. I try to check on the website, and it's like just a few of you are just watching the videos. I believe you are not going to wait till the last minute, okay? All right, take care and see you soon. Bye-bye.